If the S&P 500 is the steady engine of the global economy, the Nasdaq 100 is the high-performance turbocharger that pushes it even further. We aren't just talking about companies that participate in the modern world. We are talking about the disruptors, the giants that are literally building the future of AI, cloud computing, and digital commerce. As a Canadian investor, I'm sure you've watched the astronomical rise of the Magnificent Seven. If you've seen Nvidia rewrite the rules of the stock market and the semiconductor industry, and Apple and Microsoft become multi-trillion-dollar pillars of stability. But how do you capture that growth without headache of converting your Canadian dollars into US dollars or manage 100 individual stock tickers? The answer is XQQ. Known as officially as the iShares Nasdaq 100 Index ETF, which is CAD-Hedged, this is one of the most powerful weapons available on TSX, for those who dare. But with the XQQ stock price constantly hitting new milestones over the past couple years, you need to know, is it better than its unhedged cousin XQQU? How does it compare to US counterpart QQQ? And most importantly, is it worth the slightly higher management fee? So look, stick around because we're going to tear down XQQ holdings, the math behind the currency hedging, and why its recent stock split makes it a prime candidate for your TFSA or RRSP this year. Once again, if you dare, those swings are gonna be crazy. While broad market funds offer stability, which a lot of us seek, the Nasdaq 100 is where the growth has lived for over a decade. This index tracks the 100 largest non-financial companies listed on the Nasdaq exchange. By design, you're cutting out the slow sectors, which are big banks, insurance companies, and so on, to double down on information technology, communication services, and consumer discretionary giants. Let me clarify. XQQ is a BlackRock's way of bringing all that horsepower from Nasdaq to Toronto Stock Exchange. A major turning point for this ETF happened somewhere in late 2024 when XQQ underwent a 3-to-1 stock split. Before the stock split, the price per share was pushing into triple digits, which made it slightly more challenging for smaller investors to buy full shares with their leftover cash. Today, the XQQ price sits at a much more accessible level. And this move wasn't just cosmetic. It made XQQ one of the most liquid and tradable tech funds in Canada. So what is XQQ ETF at its core? It's an exchange-traded fund, an ETF, designed to replicate the performance of the Nasdaq 100 currency-hedged CAD index, minus a small management fee, MER. When you buy XQQ stock, you're buying a concentrated basket of world's most dominant brands. And of course, when I say stock, it's a ticker, right? It's an ETF. The XQQ holdings continue to be dominated by the titans of Silicon Valley, to no one's surprise, but the weightings shift as the market evolves. The current holdings are the AI and semiconductor core. It's got a big exposure to Nvidia and Broadcom. The companies fueling the artificial intelligence revolution here, as well as big software companies such as Microsoft and Alphabet, which you might know by its other name, Google, and of course the consumer ecosystems such as Apple, Amazon, and Meta platforms. Of course, there's also innovators such as Tesla and Netflix. One of the biggest reasons Canadians choose XQQ is the sector diversification. If your portfolio is already heavy on Canadian banks and energy, like VDY for example, XQQ adds a perfect counterweight. It gives you exposure to the one thing the Canadian market lacks, unfortunately: world-class technology and innovation. Now let's see how XQQ compares to other similar ETFs that I mentioned earlier. If you've searched for Nasdaq exposure, you've likely seen these three tickers. And here's a quick breakdown of why you would choose one over the other. So first one is XQQ versus QQQ. And QQQ is the American original ETF, which has a lower MER fee of 0.2%, but you have to buy it in US dollars. And for many Canadians, the cost of converting CAD to USD, which is at least 0.5% when buying and then again when selling, wipes out any fee savings unless you're using Norbert's Gambit. XQQ lets you skip this conversion entirely, which is why I find it useful. And the second one, XQQ versus XQQU, which is very critical to understand. The XQQU is the unhedged version, which means that if US dollar gets stronger, you make a little more money. In XQQ, on the other hand, BlackRock uses currency hedges to cancel out the movement of the US dollar. So you only choose XQQ if you want the performance of the stocks without worrying about whether Canadian loonie is going up or down. And lastly, XQQ versus QQC. QQC is Invesco's Canadian version. While XQQ MER sits at 0.39%, QQC is a little bit cheaper. However, XQQ remains the heavyweight champion in terms of assets under management and daily trading volume, which often leads to tighter bid-ask spreads. So it's cheaper to enter or exit your trade. For small investors, it doesn't matter as much, but still I figured it's worth pointing out. Now let's look at the math. The H in hedged is the secret sauce of XQQ. Most S&P 500 investors, which are using VFV or XQS, prefer to be unhedged because the US dollar historically acts as a safety net during a crash. However, for tech investors, they a lot of the time prefer XQQ because tech stocks are already volatile enough. By hedging the currency, you're removing one more layer of gambling. Let's look at this hypothetical scenario. The Nasdaq 100 rises 15% over the year. During the same time, the Canadian dollar strengthens by 5% over the US dollar. In an unhedged fund, your total return would only be around about 10% because the exchange rate ate some of your gains, actually. In XQQ, your returns would be much closer to the full 15%. So, to summarize, if you believe that Canadian dollar is currently cheap and will eventually head back towards 0.8 US dollar ratio, XQQ is one of the smartest way to play the Nasdaq. If you believe it's already overperforming and is going to go down, go the other route. Now, let's talk numbers. XQQ MER is 0.39%, which means that for every $10,000 you invest, you're paying about $39 a year in fees. While this is higher than the broad S&P 500 fund, you're paying for the active management of the currency hedge and the specific concentration of the Nasdaq 100. As for XQQ dividend, I wouldn't expect a whole lot. The dividend is paid semi-annually in June and December, if I'm not mistaken, and the yield is nothing to write home about. It's usually historically in between 0.25 and 0.5%. I would say most of the companies in XQQ and Nasdaq 100 don't pay much of a dividend. They're super heavily focused growth companies. They use that cash to build data centers, satellites, invest in production. You're buying XQQ for the capital appreciation and not the monthly income. Something you just have to remember. To summarize, XQQ is the ultimate growth engine, you can call it. It's for investors who aren't satisfied with the typical 8 to 10% average returns of the broad market and want to chase something a little bit higher. I would love to note, of course, that these are speculations and past performances don't guarantee future performance, so that's something to keep in mind. With its recent stock split making XQQ's stock price more affordable than ever, to own full shares at least, it remains the gold standard for Canadian tech exposure. Anyways, thank you guys for sticking around into this deep dive for XQQ. If this helped you understand the difference between XQQ and QQQ, for example, or why the hedge status is a game changer for some strategies, hit that like button. It helps algorithm find more Canadian investors like you and show the video to them. Drop a comment below. I'm curious to see how you're balancing your own portfolio and whether you're adding any tech to it, especially in this point right now that some people say it's overvalued. Not a financial advisor, guys, as I always say. I'm just a guy who looks at charts and does a little bit of research. I give you my opinion, but it's not financial advice. Anyways, guys, lastly, thank you for watching. Subscribe to the channel if you enjoy the content. It really means the world. Thank you so much again. I'll see you in the next one. Take care.